This is Daybreak Asia. We're counting down to the start of trade in Japan and South Korea. And at the start of the session today, we're still focusing in on really that outperformance we're continuing to see for US stocks, how much that's going to translate, that exceptionalism, how much markets continue to be able to just climb a wall of worry.
And speaking of a wall of worry, that's China for you, right? Even as we head into potentially what should be a really auspicious year, the year of the dragon. But some big changes on the eve of Lunar New Year with the head of the CSRC being replaced. And Annabelle, you know, we get more inflation or potentially deflation numbers today as well, right? So clearly they're kind of trying to shake things up to be able to make any meaningful impact to the lack of confidence.
Yeah, that's right. And take a look at how we've got markets coming online, though, in Japan today. At the start, we are seeing the Nikkei just under a bit of upside momentum coming through. So you had that US session where we saw the S&P 500 closing within striking distance of the 5,000 mark. So investors continuing to shrug off these Fed officials who are saying, you know what, we are not going to be cutting rates anytime soon. That's not phasing traders too much in this session. So you are seeing those equity gains coming through. You've got the Japanese yen here continuing to hold around that 148 mark. What else we're tracking in Japan is earnings. We're in the midst of the earnings season and some pretty strong numbers coming out so far from some of the companies that have reported. But SoftBank expected to report its first profit going back to September of 2022. Now, what is really driving that, of course, is the moves that we've seen partially in ARM, the US or UK chip maker that it listed in the US last year, but it's rallied more than 40% in that period, and so something that is helping lift the value of SoftBank's companies overall. That's one earnings to track there. SoftBank untraded at this point in time, perhaps given that huge jump we had in ARM after the bell, up more than 20%. But let's change on and take a look at what else we're tracking, because speaking of chips, actually, we had also TSMC coming out with some positive lines overnight. TSMC, it actually rose. That's the US or the ADRs that you're seeing there, up nearly 5%. So it had some very strong sales coming through for January, up nearly 8%. So it's just about this demand for AI chips that we're continuing to see here. Chip stocks in Korea, of course, a key market for chip players, going to be the ones to track. But today, so far, you are seeing those gains coming through. And the Korean won, Haidi, just fairly steady there.
Fairly steady is also what we're sort of tracking when it comes to trading here in Australia, Belle. And of course, we're sort of starting to focus on earnings season picking up with those key themes of what the RBA does, what China does with those stimulus measures, and really the resilience that we see in Australia's top companies over the next few weeks will be key. We're seeing a pretty tepid session when it comes to the ASX 200 at the moment. A lot of weakness coming through from energy, down by just about 1%, but some outperformance from the likes of utilities, almost 3% higher. Tech is doing quite well, and real estate as well, putting on over 1% apiece in those sectors there. We are watching some specific names in particular, AGL lifting the dividend. We're also watching the likes of Cochlear as well, jumping on a guidance upgrade. The Aussie dollar has seen a bit of weakness, particularly when it comes to trading against the likes of the Kiwi dollar, 65.22 is where we're at for the Aussie. Lower copper prices, a weaker offshore yuan, and of course that familiar refrain of the weakness out of China continuing to wane. In fact, the Aussie against the Kiwi touching that 2-month low, but the range-bound nature of trading that we see in the greenback is capping it from more headline losses. Taking a look at crude, I already said energy is the biggest loser here in the Sydney session, despite, of course, oil holding that 3-day gain. Middle East geopolitics still continuing to be in focus, and that is really supporting some of those prices. Again, we're also getting support from wider financial markets and some of those other lingering risks as well. We're seeing New York crude trading just under $74 a barrel, I should say, but it's up about 2.2% over the past 3 sessions. And some of that, of course, global rally and US rally is continuing to support broader risk appetite, Bill.
Yeah, and you're seeing those yields there, just a bit of a retreat across the curve. But it has been a very, very whipsaw start to the year for Treasuries so far. So let's discuss that, because our next guest says rate expectations will drive a good part of how 2024 shapes up. Let's bring in SGMC Capital CIO Ed Gomes. And Ed, I'm curious for your views. As I said, it's been a very, very choppy start to the year for Treasuries. What does that tell you about the outlook then for bonds, but also for equities?
Well, for bonds, at the start of the year, like you know, there were almost 6 to 7 rate cuts priced in by the market for the Federal Reserve. We just felt that was excessive. Clearly, rates are likely not to go up, but at the same time, the economy is not so weak that it demands emergency action. Stuff happening with regional banks. You had the New York Commercial Bank, which suddenly came under a lot of pressure. There's been a Japanese bank that had commercial real estate exposure in the U.S., of Zora, if I pronounce that correctly. That's taken a bit of a beating as well. So that sector is something to be watched closely, because the Fed will react to those events should they start to become more meaningful from a downside perspective. But until then, the economy is rock solid. The job numbers and the jobs reports were strong just in and of itself right across the board. Whether it was the headline numbers, the numbers underlying the strength underlying those numbers was just tremendous. So we don't see rates coming off as much as the market expects, probably 2 or 3 cuts. To look at the equity markets, again, the strength is in the economy is something to consider, and the leading sectors will keep powering ahead.
Yeah, we can get to the leading sectors in a moment, but you did mention about the stresses that we're seeing in terms of commercial real estate. Do you think that's going to be perhaps the next domino to fall here? Because you think back to around March last year, we had the regional banking crisis that kicked off. Are we going to see that sort of being sparked again, but this time by those property stresses?
I think one of the key factors to be looked at in the U.S. especially is just the sheer number of banks. And again, like you rightly said, last year around March, everyone was taking a close look at, I don't even know what the number is, but it's, in the many, many thousands. That clearly is not a sustainable model. There has to be consolidation. And, clearly the Fed is going to push for that in terms of regulations. And as you see tighter control and a more balanced number of players, larger players, as a result of the consolidation, you will see a lot of the issues get sorted out. Important to look at the larger banks, because if the larger banks start showing signs of stress, clearly that will be cause for concern. But until now, as painful as it is for the regional banks, it's not systemic at a larger scale.
Let's shift to where we are also seeing stresses, and that's in China, of course. The valuations that we see, it's incredibly cheap, but is that enough to bring you back in, do you think? We've been long-term China bulls, but over the last 12 months, 2023 mainly, we've had to reconsider that. Our go-to rationale was the valuations, but at the same time, you're not seeing any kind of let-up in terms of confidence coming back in, and not just retail investors, but also international investors. They have alternatives, and over the last 12 months, we've started making use of those alternatives too. India is a growth market which is going to see political stability for the next 5 years. That's our belief, given the upcoming elections. You also have a situation where the rest of Asia is also growing pretty well, and of course the US is a big magnet for capital. So where regulators are changing the playing field on an ongoing basis, international investors are sitting on the sidelines. So we're looking at China very tactically. If we see some kind of bottom coming through, we're happy to trade that through futures markets, but clearly not looking at major allocations on a long-term basis at this point of time.
If you see China as a tactical play, I do wonder how you think it ties in with the rest of emerging market opportunities, right? In particular, India, which of course, idiosyncratically has been such a market darling, but we've also seen it as being a beneficiary of a lot of these flows that might otherwise be going to China.
Absolutely. The thing to realize about China is, it's not contracting at this point of time. While business confidence is pretty weak, at the same time, there is still some kind of growth coming through. The silver bullet for China, effectively is realizing when they can signal to the broader world that the regulatory actions which they're taking are behind them and not prospectively going forward. But the rest of Asia is growing pretty well, meaning all in, there are 4.5 billion people in Asia. from the broad geographic span that one can look at. Indonesia is doing well, the Philippines is doing well, Vietnam is doing well, and lots of other countries are piggybacking off a lot of the growth in here. India, of course, is like a secular story, which will coming off a small base. You can't compare the base that India has versus China. So coming off a much smaller base, but the potential and the sheer upside there is, makes India one of our largest conviction markets globally.
Ed Gomez, CIO of SGMC Capital. Always great to chat with you. And take a look at some of the stocks that we are watching at the moment, and chips very much in focus, of course, ahead of SoftBank's numbers as well. We're expected to see an improvement, but ARM soaring after that expansion into new markets, really supporting that forecast there. Let's take a look at some of the adjacent names that we're seeing. Of course, the likes of Samsung Electronics trading pretty much unchanged at the moment. In fact, a lot of these chip names, including Hynix, is also looking pretty flat there as well. It's been, of course, a big week for Samsung as well, with JY Lee acquitted in that succession case. We're also watching Tokyo Electron seeing some gains of about 0.7%, and Advantest there as well, leading those gains by 2.5%, with some of these expectations that we'll see SoftBank coming through with some positive rhetoric.
Yeah, and as well, we're just waiting on SoftBank to start trading there, Heidi. You can see here, unchanged at this point in time. I was just actually checking the bid-ask spread, and we're outmatched by about 3-1 at this point in time. Other names, though, that we are watching here is Renesas, because it's still that earnings focus, and you can see here up more than 3%. It did push through its earnings, so some stronger numbers coming through there. Also a year-end dividend that investors are liking here. Let's look ahead to what we've got coming up, and China has replaced its top markets regulator as President Xi Jinping takes more steps to end the stock rout and shore up confidence. That and more next. This is Bloomberg. China is making a change at the top of its securities regulator in the latest step to hold a stock market slide that's wiped $5 trillion worth of market value from onshore indices since a peak going back to 2021. So for the latest, let's bring in our Chief North Asia correspondent, Stephen Engel, here. And Steve, is this a sign of desperation, or do you think this is a prudent step?
Well, I think it's another step that they have to take. They feel heading into the Lunar New Year holiday, where there's a lot of disgruntled domestic investors, obviously, especially those holders of small-cap stocks, don't feel that they necessarily have gotten the right steps. The national team perhaps supporting big caps, blue chips, essentially in China. So, again, this is a move that has been done in the past when there's been market volatility, change the regulator. The CSRC, has taken a number of steps, piecemeal approach, some would say, to stem this slide. And we've seen, of course, when certain announcements are made, the market goes up, but then it peters out because, again, it's the horse or the cart or the chicken and the egg. Which is the bigger problem? Is it the stock market, or is it that a proxy, of course, to the bigger problems, the property market slump, the slowing consumption trends, the geopolitics, the regulatory crackdown on the big tech companies, et cetera, et cetera. So, again, this at least sends a forceful message to the market and to domestic investors that we are taking this seriously, and perhaps this new guy who's going to be coming in, and I'll talk about him in just a second, perhaps will get the political forcefulness to make some changes. And the guy who's coming in is Wu Qing. He's a veteran banker, a veteran of the regulatory framework in China. He is known, his nickname, at least colloquially in China, is the broker butcher, which essentially goes back to the mid-2000s when he led a regulatory crackdown on some perceived malfeasance in the brokerage industry, and 31 different brokerages were shut down in China from his investigation and his enforcement. So essentially, he is going to bring discipline and zero tolerance for what the CSRC has already said. They have evidence of malicious short selling and stock market manipulation. So again, out is Yi Hui-min, who's been in since 2019. In is Wu Qing.
We're heading into the year of the dragon, and it's, looking very inauspicious, right? Where's the state of the Chinese economy, particularly as we get inflation or deflation data today?
Well, I think the deflation data today for January is going to basically confirm what we've seen over the last, at least on the PPI front, and the factory gate deflation for the past 15 months, is that a continuing weakness in pricing power at factories, and then that has now translated into weak consumer prices. The CPI index, as you can see, expected to continue to have fallen now for a fourth consecutive month, fifth if you count the flat growth there in September. So again, deflation is a big issue, obviously. It's kind of a vicious cycle, continuing downward spiral in prices at a time when the Ministry of Commerce essentially wants to declare 2024 as the year of promoting domestic consumption. We'll have to see. I mean, maybe the cheaper prices help spur consumption, but again, it's not something that the authorities and the central bank want to see.
All right, our Chief North Asia correspondent Stephen Engel there, and I want to bring your attention to a stock that has just come online this morning. This is SoftBank. We saw that bid-ask spread not matching at the top, but it's just come online with that pop there. You can see up as much as nearly 10% so far. What is driving that is actually the ARM earnings that came out. So ARM, the UK chip designer, being a key portfolio or investor from SoftBank there, but we had it climbing as much as 42% in late trade. It's listed in the US there, and essentially those bumper numbers playing into that optimism for SoftBank's numbers as well, due later, Heidi.
Yeah, not as much optimism as we were expecting when it comes to Alibaba, though, Bill, right? The US traded shares falling the most since November. Baba reporting lower than expected sales, overshadowing the move to extend the buyback program. Let's bring our Bloomberg intelligence senior analyst, Catherine Lim. And Catherine, it's been a long night of looking and passing through the details. What was the biggest disappointment for you?
Well, I guess Alibaba's back to square one essentially as two things. They've highlighted that they're going to make a big global e-commerce push, both at home in mainland China as well as overseas, and they are going to spend. So I think this heightened the concerns that, it's going to take a hit on their profits in 2024. And the second disappointment really comes in as they concur that the market conditions right now is making it difficult for divestments of assets, notwithstanding the likely overhang on Cainiao IPO, which is subjected to market conditions. So it doesn't look like, any of the changes that, they wanted to put through may come through in the near term.
And Catherine, there's just so much focus on how much ground Alibaba's lost to the likes of PDD in the e-commerce space. Are we going to get any signals, perhaps, that Alibaba can catch up again?
Well, do you know what? If any evidence comes through, it's not going to be in the near term. We probably have to wait until 2025 to see whether any gains can be sustained over the next couple of quarters. Now, bear in mind that Alibaba is now looking at Europe and developed Asia, and these are markets that PDD is also moving into as they expand outside of US. So it's going to be an interesting year for both companies.
That was our Bloomberg Intelligence Senior Asia-Pacific Consumer Analyst, Catherine Lim there. And let's shift to another stock we've been tracking in after hours today. That's Disney, because its shares have been rising in extended trading after the company's earnings beat estimates. And it gave an upbeat profit outlook for the year as well. So let's bring in, for more on this, Bloomberg Senior Editor Chris Palmieri, who leads our media and entertainment coverage. Chris, better than expected numbers and also pretty optimistic on the outlook too.
Right. I mean, that was the sort of big takeaway here. A year ago, Bob Iger announced a bunch of changes, cost-cutting, restructuring, and that, and now you're definitely seeing the payoff of that. I mean, revenue's not really moving much, but profits much higher. In fact, they're forecasting a 20% increase in earnings per share for the coming fiscal year. So definitely good news from that perspective, much lower losses in the streaming service that had been such a drag on profits for a while.
The other big takeaway was the $1.5 billion equity stake in Epic Games, right? Of course, the maker of Fortnite. Take a listen to what we heard from Bob Iger on this.
Our new relationship with Epic Games will create a transformational games and entertainment universe that integrates Disney's world-class storytelling into Epic's cultural phenomenon, Fortnite, enabling consumers to play, watch, create, and shop for both digital and physical goods.
Disney's had a pretty up and down kind of history when it comes to gaming, albeit a longer collaboration with Epic. What is this kind of, or how's this being received, I guess?
Well, Iger's explained this as saying that, yes, as you mentioned, they were really big in games. They even had a console that they sold at one point and owned all these video game studios. Ended up getting out of that business. It's just a very risky business. But they moved to a model that's more licensing, and this is sort of a hybrid of that. So Epic is going to make these games and put the characters within the Fortnite universe, but Disney's also going to own a minority interest in Epic, so they'll sort of benefit two ways.
There are lots of other different themes to sort of pick out from this, but there was the streaming, how many subscribers they're doing or adding, the ESPN as well, international parks. What else stood out to you the most?
Well, a whole lot going on, as always, in Disneyland. Yes, they announced yesterday this big new streaming service domestically is going to combine the sports of Disney, Fox, and Warner Brothers. They also said that they expect Disney Plus subscribers to rise in the current quarter. It was kind of flattish in the one they just reported. And if you're a Taylor Swift fan, of course, you can go to Disney Plus on March 15th and watch her Eras Tour movie with 5 new songs.
Does all of this get the activists off Iger's back?
Well, it's sort of funny. Trian, Nelson Peltz company, put a statement today saying this is deja vu. It seems that way. A year ago, as I mentioned, Disney announced they were also facing a challenge from Peltz. They announced all this cost cutting. Now on the eve of an annual meeting, they're announcing much stronger results and these new initiatives. But Peltz or Trian had said in their statement, well, look how well it ended last year, and indeed, it had still been a choppy last year for Disney. So the implication is that although the news may look good today, they're not really fully turned around.
Bloomberg senior editor Chris Palmieri there with all the details on Disney. And of course, you can get that story and some of the other stories you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers can get that at Daybigo on their terminals. It's also available on the mobile in the Bloomberg Anywhere app. You can customize those settings as well, so you just get the news on the industries and assets that you care about. This is Bloomberg. You're watching Daybreak Asia, the top corporate stories today. Bloomberg has learned that Citadel was among the hedge funds that received Morgan Stanley's trade leaks for favoured clients. Other recipients are said to include people at CAAS Capital, Siganti Capital and Evolution Capital. Prosecutors have not accused any of the alleged buy-side participants of wrongdoing. Morgan Stanley paid $249 million to settle the investigation. Sources say New York Community Bancorp has been reaching out to investors for capital to finance a large portfolio of residential mortgages. The bank is said to be considering a synthetic risk transfer backed by a portfolio of about $5 billion of home loans. NYCB is under pressure over its worsening credit quality. Ripples from the troubles in the US commercial market have now spread to Europe, with bonds at Deutsche PBB slumping over the bank's property exposure. Tesla shares jumped after Bloomberg revealed that managers have been asked to identify which positions are critical, a possible precursor to layoffs. Sources say it's also cancelled performance reviews for some employees. Tesla has roughly doubled its workforce since 2020 to around 140,000 people. More to come here on Daybreak Asia. This is Bloomberg.
Expecting all indicators to be well aligned is too high a bar. But seeing sustained, broadening signs of progress should provide the necessary confidence that I would need to begin a methodical adjustment to our policy stance.
I'm very supportive of being patient, to get to where we need to get. I see at this point the trade-off, which is, coming into better balance, is still being in favor of continuing to work on inflation.
At some point, the continued cooling of inflation and labor markets may make it appropriate to reduce the target range for the federal funds rate. On the other hand, if progress on disinflation for some reason stalls, it may be appropriate to hold the target range steady at its current level for longer to ensure continued progress on our dual mandate.
That was some Fed officials there tempering hopes for early rate cuts, but it seems like investors just don't really care that much about what Fed officials are saying at this point in time, because we've seen them continuing to shrug off this pushback on calls for early reductions in the key rate at the Fed. That really helped to lift US stocks overnight to near 5,000, that mark for the S&P 500. And so that is coming across into the Asian session so far. You've seen the Nikkei, the Kospi, the ASX 200 all in the green at this point in time. What else investors are continuing to shrug off is geopolitical tensions, overbought market conditions. These are just some of the different factors. What's going to be notable, though, is the moves that we see in China, because here it's been a very, very different story. As we know, an extremely weak start to the year for Chinese equities, and overnight as well, choosing to replace the securities regulator, the head of that organisation, telling us just how serious the problem is. But just take a look at some of the closed markets today, because China is one of those. It's, well, not closed today, but partial trading. Taiwan as well shut for a public holiday. So these are also some of the movers here that we're continuing to track, given what we see in terms of holdings. And then as well here are just, as I said, some of these markets that are shut today. But Heidi, it's that countdown to the Lunar New Year holiday.
And circumstances are pretty muted, right? As you say, even with changes at the top of the CSRC, we're not seeing great prospects for a boost in confidence as the country heads into the Lunar New Year holiday. Let's get a preview of really what to expect in the Year of the Dragon. We've got inflation numbers for January coming out in the next hour or so. Michelle Lam is a Greater China economist at Societe Generale. Michelle, great to have you with us. And we keep saying the irony of the dragon being perhaps, if not the most auspicious of the horoscopes. It's certainly looking like it will be a challenging Year of the Dragon for the economy going on.
Yes, indeed. And I think for the inflation data that we are going to receive later, I'm expecting a notable drop in the CPI. Well, partly it's because of the different timing of the CNY holiday this year compared to last year, but actually on the core CPI, I still expect the momentum to be very sluggish, precisely because the demand is still very weak for the consumers. And if you look at the company announcement, like Apple, for example, they are still announcing price cuts on the consumer electronic products at the start of the year. So that means that the consumer demand picture is not looking good.
Michelle, how concerned are you about a more entrenched deflationary confidence spiral for China, and how hard will it get to lift sentiment out of that?
So, I mean, if you look at, for China, there are two indicators. So one is PPI and one is CPI, and the PPI movement usually dictate what's going to happen for the CPI. So for the PPI, and most of the makeup is actually upstream prices, so oil prices, coal prices, iron ore prices, etc. And if you look at the development of the oil prices, I would well, it's actually pretty influenced by the international developments. And also, if you look at the hard commodity prices like metals, I would say that probably the further downside from here is probably more limited compared to, say, in 2023, because the property developments probably are starting to see a smaller decline compared to over the last 2 years. So I would say that on the upstream prices, the pressures are going to be probably improving or stabilizing somewhat. But I think the question here is still the pass-through to the consumers, because if you look at the labor market situation, there are actually not a whole lot of data that we can monitor the development. But if you look at the PMI employment indices, they are not doing great. And I think the high demand for the economy right now is also probably pretty weak. And considering that the sluggishness in the consumer demand, I would think that the pass-through of cost to the end consumer prices are actually also pretty weak, which means that I think for the core CPI, we are just looking for maybe hovering around 0% for this year.
When it comes to what sort of measures we can expect to see from regulators, given we're approaching the all-important MPC in March, can we expect anything major in the countdown from here to then?
I think right now the market expectations, and also including ourselves, on the major stimulus from the MPC probably not high. To be sure, at the start of the year, we are seeing more easing moves from the policymakers, such as the surprise 50 basis point cuts in the RRs. I would say that the magnitude is actually not a surprise to me, because they did not do anything in the fourth quarter. So taking into account, it's actually 25 basis point RR cuts in Q4 and Q1. And then they are also doing a little bit more on supporting the property funding. But it is actually still some tweaks under the current framework, meaning that they still require collaterals to provide lending to these developers or the projects. So I feel that right now the concern of the home buyers is still that whether they could to get the project completed. So I think right now it is still not really a fundamental change to change the consumers' confidence on buying the developers from the private developers. And add into that, economic expectations probably are still pretty weak right now. So I think the property sales are still going to be, maybe at best we can hope for is a stabilization for the rest of the year. So on the stimulus front, I think probably we're not expecting much for the March MPC. Probably we are going to see some special CGB's issuance of 1 trillion. But I think overall the fiscal stimulus, we are not talking about a big bang easing that we are seeing in 2008 or 2015. I think one thing to watch is, though, the PSL, because even though the fiscal support is not extremely supportive, it is modestly more supportive compared to last year, but not extremely supportive. The PSL can be stepped up anytime. So we are really watching is the monthly balance of the PSL, whether the PBOC is stepping up the lending to the policy banks that could fit into the urban village redevelopment or social housing schemes.
Yeah, and we did actually see more low-cost funding, that PSL program being added last month. But on a slightly different note, if we get that growth target as well coming out for around 5%, that's sort of the expectation here for 2024. Do you think that is realistic and achievable?
I think it could, well, actually China seldom misses its growth targets. The recent incident is 2020 when it's the pandemic. So I do believe that even though the fiscal support does not look dramatic right now, I think with, I mentioned the PSL, that can be stepped up over the course of the year. So it could be the case that at the beginning they may realize that the stimulus is not enough, but then eventually over the course of the year, the stimulus measures could be stepped up so that to ensure that we can meet the growth target, which may be at around 5% based on what the local governments have been announcing for the GDP target this year.
That was Michelle Lam, Greater China economist at Societe Generale. And let's think about all of this and put us in the context as well of Chinese equities as we head into the Lunar New Year break. It's an extended pause for mainland stocks. Bring in our Asia stocks reporter, John Cheng, for more still in Hong Kong. So, John, we were just hearing there from Michelle about all of the issues that are plaguing China's economy. We're heading into this extended break now. what's the outlook, do you think, for trading today as we get that last opportunity to see any sort of market moves?
Well, we just had this news about the new securities head coming out after market close yesterday. So that's definitely going to be a positive. But looking at ahead of the Lunar New Year spending data, I think expectations are rather soft this year. Inbound domestic travel is looking pretty strong because a lot of people will be traveling home for the extended holiday. But outbound travel is looking pretty weak, even though we have a lot of favorable policies, visa-free arrangements, more flight capacities, etc. But people are really tightening their belt because expectation for the economic outlook is still pretty weak. So a lot of people are opting for more value for money kind of travel instead of the lavish style they used to have before COVID. And also we can also look at the retail spending data. Holiday period, so there might be an increase in consumption for baijiu, typical Chinese alcohol, and also some other consumer items like sportswear, etc. But likely that boost will be temporary because after the holiday season, people are still likely, continue to tighten their belts. So, any that kind of boost will be temporary, I believe.
And usually box office takings during holiday periods are also a key metric.
That's right, yeah. So I think, again, expectations for this year is looking pretty soft. Movie-going demand is still pretty robust, but the pipeline of movies coming out is not as strong as last year. So that might negatively affect the box office for this year during the New Year period. And also Macau casino gaming related stocks will be also another key sector to watch. A lot of mainland tourists will be going to Macau to spend money. So that will be potentially another boost for the sector.
Asia Stocks reporter John Cheng there as China prepares to head into the Lunar New Year holiday. More to come here on Daybreak Asia. This is Bloomberg.
While there are some clear non-starters in Hamas's response, we do think it creates space for agreement to be reached. And we will work at that relentlessly until we get there.
U.S. Secretary of State Antony Blinken there on Hamas's response to a proposal to pause the Gaza conflict and release dozens of hostages. But Israel seems to have rejected the terms from the militant group. Prime Minister Benjamin Netanyahu says Israel will continue to press on with its fight. Bloomberg's Michael Heath is with us. So is this some gamesmanship that's going on, or how do we interpret this?
Yeah, look, I think it's more than gamesmanship. I mean, the reports are that Hamas's proposal goes over 135 days. There's 3 45-day sections. The first would see, among the Israeli hostages, women and the elderly and ill, and men under 19. There'd also be aid that would go into Gaza, and Israel would withdraw from from built-up areas, from civilian areas. The second 45-day stage would see Palestinians released, the remainder of the Israeli hostages, and Israel withdraw from the Gaza Strip. The third stage would see them switch over corpses, hand over corpses from either side. I mean, so the reports in the Israeli press, despite what Prime Minister Netanyahu said, is that some Israelis in government circles are taking this as a high first offer, that it is serious, that there is scope for grounds for talks, as Secretary Blinken said. But by the same token, there's a lot they'd have to give up to do that, and there's a lot of politics about this as well. So then the question just becomes, what are you prepared to give up for those hostages? And that's what they'll need to decide there.
Yeah, and at the same time that's going on, you've also got the US that's carrying out airstrikes in Iraq as part of a retaliatory move for the personnel that were killed last week. So just talk us through what's happened there.
Yeah, I mean, that's exactly right, Annabelle. And so the US is continuing its campaign. I mean, 3 US service personnel were killed. There's been obviously a lot of strikes by various militant groups in the region against US forces. A lot of those US forces are there to deal with Islamic State and various stability issues. But yes, a senior commander was killed in a strike. There aren't a lot of details from the US release. There's other reports that are saying that this actually took place in Baghdad, but whether it's the same thing, it's often hard to tell there. But yeah, the US has sort of calibrated its response to these deaths. It doesn't want to directly, even though Iran sponsors these groups, it doesn't want to directly, it seems, be hitting Iranian personnel. It just wants to keep that to the militants as part of this effort to stop the war from widening from the Gaza Strip. As that's been a constant US priority. But again, this comes back to the deal that if you get some sort of truce here, you probably get greater stability coming across the region as well, and that'll bring more confidence for everyone. But we're a long way from that yet.
Yeah, certainly something to track very closely. That was Bloomberg's Michael Heath there, and some other geopolitical news that we're tracking this morning. The US Senate has axed a bipartisan bill on the border with Ukraine, with Republicans rejecting the measure as it was unveiled. Former President Donald Trump had criticized the legislation, and House Speaker Mike Johnson said it would be dead on arrival in that chamber. Majority Leader Chuck Schumer now plans a separate vote on aid for Ukraine and Israel without US border provisions. The Biden administration is planning a new effort to prevent foreign adversaries from accessing Americans' sensitive personal data. Sources say the president may sign an order as soon as this week. We're told the plan focuses on preventing China, in particular, from accessing data, including information on individuals' finances, genetic makeup, and voice patterns. Pakistan will close its borders with Afghanistan and Iran on Thursday as voters go to the polls. The decision comes after 2 bomb blasts targeting political headquarters in the northwest killed at least 20 people at the day before national elections. Former Prime Minister Nawaz Sharif is expected to return to office with his biggest rival, Imran Khan, in prison and disqualified from ruling. Be sure to tune in to Bloomberg Radio to hear more from the day's big newsmakers and get in-depth analysis from the Daybreak team, broadcasting live from our studio in Hong Kong. You can listen via the app, Radio Plus, or BloombergRadio.com. Plenty more ahead. Stay with us. Uber has reported gross bookings that beat analyst estimates. That's with strong demand or global demand for rides and food delivery during the holiday period. We broke down the numbers and the outlook with CEO Dara Khosrowshahi.
Trips, 24% on a year-on-year basis, on a base of 2.6 billion trips. So, as you get larger, it gets tougher to have that kind of growth. But if you look at our gross bookings guidance going forward, it's between 18 and 23%. So we do expect to continue to grow at very, very strong rates, while at the same time continuing to increase profitability and margins, which is the best of both worlds, which is what investors expect of us. And frankly, it's what we know Uber can deliver.
Well, shares just turned positive, so investors are liking what you're saying. Let's talk about the other half of the business, and that is delivery. You had to raise some fees in some markets. You added multi-store ordering. What more can you do in delivery to keep this up?
Well, there's a ton going on in delivery. There's obviously the core online food delivery business. Overall delivery grew 17% on a year-on-year basis, and it's actually accelerating, Emily, right? So it's accelerating versus Q2 versus Q3, and it is about getting the basics right. The first thing is customers want choice. We now have almost 1 million restaurants on our site on a global basis, up about 10%, but they also want reliability. So when we measure the number of orders that we get wrong, the number of orders we get wrong are down 25% on a year-on-year basis. So the business is reliable. You get what you expect as well. And what that's resulting in is our audience is growing, frequency is growing as well. And then as eaters order more and more in a basket, actually basket size is growing. So the growth that we see in eats is very, very broad. We're adding to it grocery, which is a segment that we're very excited about. You know, the grocery business is actually bigger than the online food business, than the food business in terms of total size. Our grocery business is still pretty young. It's about $7 billion now run rate, growing over 40%, and we're very excited to introduce the grocery experience to all of our eaters out there.
Uber CEO Dara Khosrowshahi there speaking with Bloomberg's Emily Chang. And we've got some interesting developments when it comes to, I guess, you can call it the drawing of these boundaries when it comes to how office workers deal with, potential demands from managers and from other employees. And we've seen this kind of trend really begin in Europe, right? This, regulatory and legal limitations on whether employees have the right to communicate after business hours and whether employees will have the right to essentially ignore them. Australia may be following suit in giving workers the right to disconnect after office hours. Businesses face potential punitive consequences for calling or emailing their staff once they've clocked out. So we could see that measure pass as soon as this week if we see the Greens Party and independent senators and centre-left Labor reach a deal, Belle.
Yeah, it seems like they could have reached that already on Wednesday, but what I want to know actually, Heidi, is this going to apply to Australian citizens that are living abroad? But it's certainly a big step forward for Australia. And, as you said, something that we've already seen in parts of Europe, just giving employees that opportunity to step away. The final form of the legislation is we understand that hasn't been released as yet, but it would mean an employee has the right to refuse to monitor, to read, to respond to contact or attempted contact from an employer. So, yeah, I think something that could be good, of course, if you're employed. I don't know how you feel if you're a boss or a business owner out in the market today, but something to look ahead to this week.
Well, I also just wonder if you ignore those emails, Belle, you know what it's like to come in the next day or come in after a holiday and be faced with hundreds of emails that, it's what's the worst of the two evils, right? Ignoring them and then having to deal with them at a later date, or just taking that communication.
Yeah, that's right. Check whilst you go along or when you come back. But some of the movers as well we're tracking in the session today. We've got chip stocks. We're continuing to monitor those, and SoftBank really standing out to us here. That pop of 8% there. After we had ARM as well, the UK chip designer and a big backer of ARM, that SoftBank, posting a very strong forecast. So it's all about this demand for AI chips that's coming through, and that's boosting other chip-linked names in Asia today. Earnings continuing to track as well. So we've got Dina, for instance, that's falling quite sharply after its third quarter operating loss. That was bigger than expected. Dina is a company that owns the Mobage platform, which is one of the most popular cell phone platforms in Japan. Suzuki Motor as well, you're seeing that weakness coming through there for the car maker or automaker. Again, a third quarter profit miss. And then you're seeing as well Kyowa Kirin. That's a pharma company that's spiking here, issuing another buyback. It's something we've seen from quite a few Japanese corporates. Coming up in the next hour, UBP sharing their outlook for Alibaba. Those earnings ahead.